Just wait for a minute. I think some guys got logged out. Mm-hmm. Okay, we are good to start. So, thank you everybody for joining in today. Yet another virtual connect from Silas. So, today we wanted to specifically, do a meeting to talk specifically on what we think about the three major geopolitical things that have happened. One is the EU trade deal a couple of weeks back, the budget that came last Sunday, and finally the India-US trade deal, which was announced, I think on Friday night, right? Uh, yeah, so let's dive right into the presentation. And if you have any questions, keep them flowing. We have a slightly longish presentation, but I'll try to wrap it around 30 to 40 minutes, and then we will take up the Q&A. So the India-EU trade agreement, this is something unique that we have been finally able to do. In fact, over the last 2 years of this, the new Modi 2.0, or you can say the 3.0, what happened was there was a lot of talk of finally, achieving negotiation, which has been extended for almost 18 plus years now. Now, this is a very unique opportunity, not just because a US deal is not available, but also because European Union is actually much more stable market than a US economy. You may point out that growth is not happening in EU; it's only with US where there is so much growth, so much import. So that's why the overall opportunity size is much bigger. But what happens is, see, with the European Union, we already have some relations, but there were a lot of barriers in the industry. Example, something as basic as like gems and jewelry. Now there used to be import tariffs. There used to be limitations on certifications that were typically allocated to the Indian gems diamond industry, but were not acceptable in the EU region. Now with trade deals, gems has actually become a specific part of it, through which we expect the gems industry itself, kind of the exports, which were close to $2 to $3 billion in 2024 calendar, can go to as high as almost double in a year or two from here on. The other thing is, specifically just textiles and leathers. What was happening was the Asian competitors like Bangladesh, Vietnam, Indonesia, these countries had much lower tariff. On an average, the Indian export of textiles or leather was prone to a 10 to 18% tariff rate, 10 to 25% blended 18% tariff rate to the European countries, whereas somebody like a Bangladesh at a blended basis had only 13% tariff rate. So there was a 5% arbitrage between India and Bangladesh exporting the same product to the European Union. Now this has finally been demolished. In fact, within the current numbers, we think it 0 to 10% is what the agreement mentions, but on a blended basis, this could be somewhere around 5 to 8%, which will be a subsequent, I would say, material discount to what the other countries are paying. So that itself could add to the profitability or the margins enjoyed by the textile or the leather players in India. The other aspect of it is on the chemical side. See, chemicals, what has typically happened is there has been lot of work between the European countries, which are the end product manufacturers, versus the Indian suppliers. But usually the stickiness had come only because of post-COVID, when the European countries were looking for a China plus one supplier. And in that also, what typically happened was these European companies, they were looking at Indian manufacturing primarily for their Asian supply. So that is the non-China market, what they wanted to export products. Instead of exporting it from Europe themselves or from the China, they looked at exporting it from India. Now, with the new trade agreement that has been arranged with, what we are expecting is India will aggressively start supplying not just to the Asian exports of the European countries, but also to the Europeans' domestic demand as well. The reason being the removal of import tariffs completely. Now, this will also become another major boost to new product development. So earlier, what used to happen was, say, some European chemical companies like BASF or Solvay, they would typically have your local suppliers for the trial testing period itself. And until the product would scale up and become material, the change in raw material sourcing would not happen. Now, with removal of tariffs, what can happen is right from the pilot batch itself, the Indian supplier can start processing the batches for the European customer. And as the product scales, the Indian supplier will get major benefit out of it. Example, point is case companies like Aarti Pharma Labs that we used to have in our portfolio, or Shilpa Medicare. These companies have tie-ups with US and European formulation companies, and they are starting to get some molecules from the initial stages. But now that complete tariff elimination happened, and there's also a complete review in how Indian suppliers are approved by the European or the US. So the EU region has something called as GMP, which is your General Manufacturing Practices. And just like US FDA, you may have heard of Food and Drug Authority in US, the EU GMP also does audits. Usually, if the FDA approved the site, the EU GMP certificate will also come. But now with the revised, the thrust in the implementation of the EU FTA, we think the GMP auditors will actually start directly, reaching out to the Indian pharma companies, and that way Indian pharma companies may be able to start supplying to the European Union ahead of their supplies to the US markets. The other part is, European companies are now getting incentives. So it has not been exactly laid out what the incentives are going to be. But if you think about what has happened in the budget, as well as some of the usual incentives that are available for foreign capital investing in India, I think there will be something additionally that will be given through this free trade agreement discussion, by which we expect companies looking to make manufacture in India, and like I said, supply to the global markets, not just the Asian or the European, but the global supplies may start happening more from India. This is good because it creates job opportunities for the Indian economy. Then supply chain diversification. This has already been a trend since COVID. We have been getting, I would say, small benefits out of China plus one philosophy of supply chain. But now with the FTA agreement, definitely this is going to take a much bigger thrust. Textile, like I mentioned, there's a straight 4 to 5% arbitrage versus a Bangladesh company supplying. In fact, we had invested in a company earlier called Pearl Global, which had actually set up a major unit in Bangladesh primarily to offset this the tariff difference between India versus Bangladesh. And now with the revised structure, they may think of instead of exporting from Bangladesh to Europe, they may think of exporting from India to Europe. So that way, which typically should have much more profitability improvement for the company, primarily because Bangladesh has been going through multiple civil unrest. Lastly, like I said, the FTA gives very low duty on most chemical exports, and this is not just to something like textile chemicals or the agrochemicals, but also on industrial chemicals. Many bulk drugs which were hitherto only supplied from China, now through the FTA and the China plus one diversification in supply chain, may start getting exported from India as well. There are many medium-sized bulk drug companies which can become major beneficiaries out of this agreement. Case in point that we have is again somebody like an Aarti Pharma Labs, or someone like a Valiant Organics or Granules. But what I would also like to highlight today is that these are not immediate buys. Reason being, most of these things will take a few years to actually start showing in the performance. Right? This is not something that will happen immediately. I think other than textiles, among all the companies that are in there, other than textiles, we do not see a material flip immediately from the EU free trade agreement. The other part is, however, that something like chemicals, what is going to happen is we may start seeing higher input prices in India itself, which will then get passed on to the European customers, and that may lead to some margin improvement for the companies. That will not have a volume improvement, but a margin improvement is what we are expecting. Next is we want to discuss on the union budget. Now, over the last few years, the amount of hysteria around the union budget has actually increased, especially last year when there was a material change in the direct taxes code. Increasing the minimum what do you call the basic exemption limit to 4 lakh rupees that happened 2 years ago. Then introduction of a rebate up to 12 lakh rupees that happened last year. These things have caught a lot of fancy among investors. But we would like to mention that if we look at the last 7-8 year history or the overall 10-year history of the NDA government, the union budgets have not really been any material, game changers, barring, I would say, 3 out of the last 10 years. There was not really something that was actually to look forward for in the budget. Rather, things like buyback taxation, dividend taxation, which have been brought in recent years, have actually been a negative impact on personal finances. So this year, the budget, like I mentioned in the newsletter as well, we expected no change to happen for the personal finances of a household, and that's what has happened. A welcome, or I would say this again was more in line of expectation as well, is a clarity on how the buyback is being taxed. Now, if you notice, last year, I think in our portfolio companies, we had 2 buyback cases, and it was a very, very tricky situation because based on each investor's individual tax slabs, the return arbitrage or the performance generated was materially different. For somebody in the zero income tax bracket, he would have enjoyed a buyback versus somebody at a 30% tax bracket, wherein the buyback was actually a negative event for them. So fortunately, the finance ministry has looked into it and given a clear clarification that whatever buyback happens, if you are a retail investor, now mind you, who is a retail investor? A retail investor is a guy who's holding 2 lakh worth of shares in an individual company. Right. If you're holding more than 2 lakh rupees worth of shares in an individual company, you are not categorized as a retail investor. So if you are a retail investor holding 2 lakh rupees worth of shares, then your buyback transaction. So for example, the Infosys buyback happened last few months ago. I imagine the same has to happen in the coming financial year as well. Then you will get the advantage of treating that as a normal capital gains and paying the usual, either it is 20% for short-term capital gains or 12.5% for long-term capital gains. But if you are holding something more than 2 lakh rupees, which is being sold via the buyback, then the tax incidence will fall at the highest tax slab, which is up to 30% for individual investors. Here, mind you, there is another interesting take. It will not. Some investors think that this will impact if the total amount of buyback is less than 2 lakhs. The answer is no. A retail investor category is only applied if the holding of you as an individual investor in that company is worth 2 lakh rupees or less. Right. I hope this is clarified to you, and be rest assured that if such event happens in any of our portfolio companies or we take a bet specifically for that situation of buyback, we will very clearly lay it down for you at what would be your individual tax liability from the deal. Now, the other change was on capital gains and sovereign gold bonds. Now, once again, we have not been a fan of recommending investors to buy sovereign gold bonds from the market directly. The reason being the market is actually very illiquid. Meaning, if you bought say 1 gram worth of sovereign gold bond from the government will charge you the 24 carat prevailing rate on that day. But if you have to go and sell that in the market on that very day, the price that you may get may be higher or lower, depends purely on how the sentiment in the market is. There was in the past periods of 22, 23, 24, when the gold bonds would actually trade at a discount to the prevailing gold prices. And on the other side, in recent months, there was a premium attracted to sovereign gold bonds, primarily for a reason that you could buy and sell a sovereign gold bond and it will be tax free. Now, this was a massive loophole which some investors were trying to take advantage of. And we strongly believe that this is not something that will actually fall into place. And here we go, the government has finally plugged the loophole. So now that anyway sovereign gold bonds are not being issued by the government, all we recommend to you is whatever sovereign gold bond that you have bought, do not sell them in the market. Keep holding them all the way till maturity for two primary reasons. One, you will keep getting the interest and the amount, the whatever capital gains that you're going to book, which is going to be material, is going to be tax free. And second, which I would say more of from a investment and risk reward perspective, we feel at these valuation, gold continues to remain an attractive portfolio bet. Next is the change on securities transaction tax. We don't think it is any relevant to any of you investors because most of you anyway do not do futures and options. And even if you are doing futures and options, the change is not as material. Probably something like you were paying 100 rupees per contract as STT, you will end up paying 150 rupees per contract as STT, or maybe up to 200 rupees if it's an option. So it's not a massive change that way. On the other side, the good news is that some of the daily use items like mobile phones, tablets, the laptops, etc., microwave ovens, critical drugs, cancer-related drugs, hypertension-related drugs, etc., then imported leather footwear and EV-related parts, all these will get cheaper. There are also a lot of corporate level changes that have happened through the budget, wherein things imports for consumption for corporate purposes are actually getting some lower duty, and we feel those decline in import duty or customs duty will get passed on to end customers like us. Lastly, on international travel, there was a TCS that was introduced. I think this was again 3 years back. Happy to note that the government has reduced it to 2% from almost 20% in some cases. So these are some changes on the budget from a personal or a household finance perspective. Like I mentioned, there is no material change as such, but some of the transactions that you could be doing, you will start to get some benefit out of it. And like I said, at an overall budget level, if you think about a normal family household basket, we feel because of the lowering of customs duty on some of the important critical items, overall a 2 to 5% improvement in or reduction in household consumption may happen. But most likely that will get offset by inflation in prices as well. Okay, now about the US trade deal. Okay, sorry, I missed this part. Right. So on the budget, the other part we just wanted to highlight some of the interesting things that we thought, which will kind of stand out for investors, is that the capex has overall the budget capex has increased by 1 lakh crore. To be frank, this is not a material change. If you look at a percentage of GDP, we were spending 4.3, 4.4% in the last 3 years, and we'll continue to spend the same 4.3% in the coming year as well. There are some very interesting initiatives, I think, which could help our portfolio companies, specifically on the biopharma side, that a 10,000 crore rupees dedicated ecosystem is being built to support biologics. Currently, we do not have much allocation to biologics or biosimilars, only ancillary exposure through some of the API companies that we hold. But now we will be looking at one of this idea as well. Then a proposed SME growth fund. I think this is a fantastic idea, especially for small and upcoming businesses. Many of you investors who are running business as well, over the years we have been recommending to you to use the CGMS scheme, which is the central government's guarantee. This is typically some amount of guarantee that the central government gives to you based on the size of your business for taking additional loans, which could be used for working capital or for capex. A dedicated 10,000 growth fund for this purpose over and above the guarantee scheme, I think is a very happy move. This should definitely fill up some of the loan transactions that have been stuck over the years, primarily because the yields were not attractive. Then a major shift is on the electronics component manufacturing. There is a major improvement. So 23,000 crore of subsidy has now been increased to 40,000 crore. However, there is a catch here. See, most of the electronics component, the EMS incentives are PLI related, and there has not been any change in the PLI scheme as such broadly. Maybe the government may come out and announce some new PLI schemes, dedicated to some particular components, etc. But also what we notice is from the 23,000 crore that was there last year, some increase was anyway warranted because many of these companies have actually achieved the export targets for which they got the PLI. For those who you may not know what is PLI, PLI stands for Production Linked Incentives, wherein the central government and the state government, in their own proportions, are actually giving you incentives if you, for example, you do a capex, and the expected revenue from that capex is say 5 crore rupees annual revenue. I'm saying, so the government, what they do is they will put a floor at say 3 crore rupees, and whatever revenue you are able to do every year above the 3 crore rupees, for that incremental volume, you will get some incentive directly from the government, which is typically paid in the next financial year. So whatever was, I would say, accrued in this financial year gets paid typically in the June to September period. So we feel some of it may go there, but we are hopeful that there will be some new schemes as well related to production linked incentives. I think this has been a major success across the companies that we have tracked, that many of them have actually benefited because their overall gross margins then became competitive from day one itself, which helped them to continuously boost production and achieve not industry leading as such, but reasonably competitive gross margin performance. Lastly, government has finally spoken something about the rare earth corridor, where they mentioned that they will be creating dedicated corridors for movement of rare earth materials. Now, please note, I think we mentioned this 4 or 5 webinars ago as well, that rare earth does not mean that the product is rarely available. It just means that it is difficult to mine that product. Something like these, magnetic minerals, which help improve the magnetism of some of the like auto sector, etc., or even the sensors that you have in your vehicles or nowadays in gadgets. So those sensors require some magnetic parts. Now those minerals are very difficult to process, and what the government is doing is, the government has not yet dedicated some funds for it, but they have mentioned that they will create corridors through which, for example, say some minerals which are abundantly available at Tamil Nadu as well as Gujarat, right? So now these are in 2 different regions. So what the government is proposing is, they will have joint corridor wherein you can set up a unit at one place, either in Gujarat or in Tamil Nadu, and the ore that is mined, say in Gujarat, will come to Tamil Nadu and it will get processed in Tamil Nadu. The reason is you need to do bulk processing of ore to get something like 1 ton of ore needs to be processed to get few grams of that rare earth mineral, right? So by having 2 different regions with the same mineral, our supply chain is poor, because this region, let's say example Tamil Nadu may have few tons and say Gujarat may have few tons, But if both of them can be combined and processed at the same unit, then it becomes the operating leverage kicks in, and this becomes a profitable venture. And that is an interesting idea that the government has come up with to improve rare earth availability in India, as well as support research and development on rare earth minerals. Lastly, an interesting update from people who are outside India, wherein the NRO, non-resident Indians, the NRIs, who have opened accounts, etc., they used to be skeptical of putting money back into India or of coming back to India for say working from India, even though they were working for a global or a developed market base. Reason being, the salaries that they were earning outside India would get taxed doubly in the other country as well as in India as well. And this was happening despite double taxation agreements, primarily because of specific leeways around what is a business income versus what is a salary income. Now, by government giving a blanket exemption that whatever income you are earning from your global assets outside India will remain tax-free for a period of 5 years, it actually supports many of these NRIs to think of coming back to India if required, or despite having their assets in other global markets. So this, I think, is a very welcome initiative, and considering the way geopolitics is turning and many expats are looking back at coming to India, I'm sure many of you will find that as an attractive attractive setup now. You already covered the personal household budget changes, right? So now on the trade deal. Very first point is that, guys, this is an interim deal. This is not a final agreement. Okay. And the primary thing that has happened till now is that there was a punitive 25% tariff applied on a blanket level to all imports inside US from India. This has been removed, but it is not yet confirmed whether India has committed to completely close Russian oil imports. We will have to see that. What it does immediately is this 25% becomes an immediate relief for all of these companies. So especially coming from Tamil Nadu, we have seen the Coimbatore textile belt, which was struggling, the Surat textile belt and diamond belt. They were all struggling for business because of this punitive tariffs. So they become immediate beneficiaries. Same can be said about leather and seafood as well. And interestingly about auto components, we were tracking couple of companies that were actually under limbo because the entire upside to their growth was expected to come from supplying to US, and that had got hit because of the tariffs implemented since June 2025. One company that immediately comes to our mind is Gem Aromatics. I think it was a recent IPO that collapsed almost 50-55% from the IPO price. We think now that the tariffs are removed and potentially the industry is also doing better from here on, the stock may do well. We are evaluating an idea at the moment. It's not an immediate buy. Please do not act on it. But these are some, like I said, like these, some companies are there which will start seeing improved performance from coming quarters, and we will try our best to kind of time and entry into them. Next, what is happening is that this what we needed and what we are getting also from right now is that pharmaceuticals and chemicals. So the faster approvals and regulatory cooperation, this is a very welcome move. We had seen in the last 2.5 years that many of our pharma companies and even the chemical companies who had done a lot of product registrations and filings had not yet got their products approved. One of the primary reasons we believe is because of Donald Trump and their apathy against India. Hopefully that goes off. The other is on IT and services with the introduction of punitive pricing on H1B as well as B1 visas. It is, to be frank, it is not yet clear what they do, but I think this is what we definitely need, and there is clarity on what really happens. What we do believe is if at least it is not complete benefit if we can get out of the IT, the visa issue, at least if there is clarity in terms of how many, say competitively, say a guy coming from China or in Vietnam or in Indonesia in the IT industry, or the Philippines in the IT industry versus somebody going from India, there should not be a what do you call it, discrimination in that. We have an equal chance of getting the visa. I think if that clarity comes in, that itself will be a very good fillip. But overall, we remain slightly negative on the IT industry, not because of the US tensions, but more because of how AI is, kind of impacting the entire economic environment. And there are talks on manufacturing electronics. I think definitely there is going to be stronger supply chain links, especially because India is now open to higher FIIs in many manufacturing sectors. And with the trade deal, even the US, major players who were looking to invest in India in the last couple of years, but were wary because of what the government administration of the US could do with India, were staying away. We think they may now start thinking positively and may actually start acting on their original plans. So this is a quick, kind of a summary on what the sectors are that are benefiting, as well as some of the companies that we think could get benefit. Mind you, I think none of these companies are actually in our portfolio because we have been staying away from these highly volatile and event specific, because this was like a coin toss event. Nobody really knew when this will actually happen. So we have stayed away from these industries. But yeah, if I think some of you are holding some of these stocks, so it's a good time for you to be invested. Or I would say remain invested in these ideas. Just go to the Fed. So nothing specifically I would like to talk about it, but if you have any questions around who benefits and what benefits, we'll happy to take that in the Q&A part. So now one major question that keeps in our mind and rather kind of forces us to be a little pessimistic about the companies that could get actually benefited from the US export opportunity is the Russia issue. US really wants us to pivot away, and the Indian government, we feel, is unlikely to let go of any of these sovereignty issues like energy, etc. That they will completely cut off relations with Russia just to be an ally of US. But what we could actually be open to is increased coal and oil imports. I think that is something that has been signaled in the press release that has happened in the last couple of days from both the governments. Is there will be increased amount of coal and oil imports, potentially even buying Venezuelan oil. By the way, Reliance used to be a major customer for Venezuelan oil because their refinery in Jamnagar is one of the best in the world, and they can actually process crude which has very, very high bitumen, which why many of the other countries are not keeping on Venezuelan oil. However, what we understand is in the last 3-4 years, many other players, not Indian as well as Asian, have actually improved their capacities and functionalities and are now able to process the lower quality, I mean, whether it is high sulfur, high bitumen, or dense crude from Venezuela. And hence, it is not really something that India has a specific opportunity in. But yes, what can be mentioned is that Reliance, which used to import crude specifically for exporting, and that in that it used to be Venezuelan imports, which had then shifted to Russian imports. It may now probably shift back from Russian to Venezuelan imports, and that may, would say a appeasing thing for the US trade agreement. Regarding coal, I think Coal India continues to be very aggressive in its mining plans. Not really sure how much coal import will that way, kind of be required, but definitely in the way solar and other renewable energy sources are, even though capacities are being added up, the power generation is actually increasing in a small, a slightly snail space, right? And because of that, we may see, at least for the next 4 to 5 years, higher demand for coal versus because of the overall demand supply gap in electricity consumption. I think on the agri market, I strongly believe the US agri companies are continuously lobbying for the entry into Indian markets. Reason being something like a corn, the maize. What happens is in India, the minimum support price, the MSP by the government is almost 24-25 rupees per kg versus the global price is something like 17 rupees. And based on latest channel checks in the mandis that we try to get insights from, the prevailing price is 21-22 rupees. So that's a straight 4 to 5 rupees, almost like 20 to 30% upside for these US corn producers. However, the problem is on adulteration. What I mean by adulteration is that in US, the crop is genetically modified. That is why it's called GM crop. And in India, we have been strategically away from GMO for most of the crops. GMO crops are only, confined to certain regions in India, and those regions do not have agricultural output. Rather, the entire output from those farms are for industrial consumption only. The reason is if a genetically modified crop, whether corn or wheat or any other barley, gets imported into India and the seeds etc. get contaminated with the non-GMO, which is your original, the virgin seed quality. We feel that will be bad not just for farmers but also for our individual health as well, because the output of these genetically modified seeds are higher, but the nutrition, there are multiple research studies that claim that the nutrition actually takes a hit. Then the other part is the US government is also looking for medical devices, reduction. Indian government, to rein in on prices specifically of stents and knee implants, had put caps to what maximum you could pay for a stent. And interestingly, today the stent prices in India are down by almost 55% what it used to be in 2018. And more importantly, it is today at a 70% discount to prevailing global prices. Now, this, here, this is where the government will have to weigh whether it has to look at the greater good or it has to look at to be an ally of US. And we feel that things like stent and knee plants, which are getting more penetrated in India today, many people, they say 1 in 10 households have at least one member with a stent today. With that kind of penetration, and where stent is something that has repeat usage as well, after a few years, once again, you may have to get a stent blockade removal, etc. So we feel the government should not ally with the US again in this part. Probably something that India can, kind of give to offset is giving them some a beneficial access when it relates to the data centers on nuclear energy. One more part I just missed was on the intellectual property. US has been pushing really hard, that India actually aligns their IPR standard with the American norms, which I think if the Indian government approves will actually beneficial for both the countries. Also for India, because a lot of innovation actually happens when IPRs are protected. Now, if you look at the case of China, okay, the IPR rights are very poor. And what has happened is they are very good at copying and cloning, but not as good as innovating. What has happened for them rather is that the innovation has always come out of necessity. In India, rather, there is no incentive to innovate because there is no protection. So either we can go towards a Chinese model where there is rampant abuse of IPR, through which lot of technology gets passed on the hands and gets diluted, and that way in future, when the necessity arises, we can actually innovate, or else start protecting IPR rights from day one, aggressively align with what the US already proposes, which is supposedly the gold standard in IPR rights, and that way help boost innovation from the scratch in India today. That again is a long shot because it may take a couple of decades before we actually start seeing benefit of these innovation and the investments. But I feel it was better that way than following the Chinese model and just being a copycat guy. Like I mentioned, there are offsets. I think these three things definitely the Indian government can offer, and aviation I think has already been offered in the latest deal, wherein I think $80 billion is the number that's being floated around, but we feel it could be $100 billion project as well with an India offset clause. Now, what I mean is India offset is that India will import a product from Boeing, provided Boeing does some amount of the raw material sourcing for that product from India itself. Or maybe the value addition that happens, something like assembly happens in India itself, thereby creating technical know-how as well as job creation for Indian economy. Nuclear energy, something I think that again can be accepted, and already again in the trade deal it has been in the latest press releases it has been mentioned that this is what something that can be opened up for US. And data centers, I think in this budget that was a major announcement as well, that the tax holidays which were previously only till 2035 and 2042 based on different plans have now been extended all the way till 2047. So that means if you're setting up a data center today, on an average, the data center takes 2 to 3 years to kind of set up, and another 1 to 2 years to achieve full utilization. So 5 years, and after that till 2047, there's another 17 years. It's a tax holiday. So that improves the returns that the data center investments can actually generate. Okay, lastly, before wrapping up, and I think not much time is left, I'll quickly go to the Q&A, the market view. We feel, and again, this has been repeated in our newsletters as well, that markets will remain sideways till July for the moment. It may extend to September, we don't know. But do not get, kind of like last week, because the trade deal happened, the markets were up 3-4%. I think it was just for a few minutes in the morning. But I saw a lot of investors were very excited, feeling that this is the mother of all bull run rallies starting, etc. Believe me, this is not a major step. The major step can happen only a couple of quarters from here on. Like I said, a full agreement has to be reached. Lot of tinkering still needs to be done. Lot of negotiations will happen. After that, only implementation will start. And once the implementation start, can we see the benefits happening for the economy as well? So what are we seeing currently? We are looking at 3Q earnings till now. I think 50% of the portfolio has come up with earnings. Results have largely been good, much better than what we expected. Fund flows are okay. That is why if you notice overall for the last 1 year, market is showing a plus 9%, but that is only at a Nifty 50 level. At NSE 500 level, if you notice, it's almost flattish to slightly negative. So that shows that, we are still not out of the woods in terms of portfolio performance. What are we doing? We are not recommending much of investment ideas at the moment. Like I said, we are evaluating some trading ideas. Even with the trade deals in mind, will be coming up with a couple of short-term ideas, probably 2 months to a year horizon, which will help us make some returns. And the theme for 2026 is primarily going to be discretionary spending from the consumer. Like I mentioned, lot in the budget as well as from these trade agreements, we are expecting a lot of the imported products to become cheaper for personal consumption, and usually that it is from a discretionary. So what you mean by discretionary is that products that you don't use daily, but things that you may occasionally want to buy. So those kind of products we feel will get more demand in the coming year, in the current year. Then, like I said, chemicals and textiles are definitely going to be some interesting spaces, and we are working on ideas on that. Lastly, I'd just like to reiterate that investing outside Indian equities is a very exciting time right now. We are currently evaluating a couple of funds that invest in Europe from India, and we'll be giving the recommendation on that as well. We already recommended the Axis Greater China Fund to most of the investors. We have recommended gold as an investment opportunity. We are looking at other markets as well, maybe Korea, you never know. So our team is evaluating all these other geographies as well as other alternate asset classes from where we can probably generate higher returns versus the stock market. That's it from our side. With this, I wrap the Yeah, so open to Q&A. Please start posting your questions. Okay, on SRF. Right. So, guys, SRF, UPL, these are two companies that we recommended, I think, early last year. The basis for that was primarily driven by how the US economy is expected to do. What we have seen is even though the economy did well because of all the tariff tantrum, etc., these companies couldn't see the higher realizations that they were supposed to enjoy because of the margins getting offset by some of the import. But what happens typically is with this tariff is that over multiple quarters, the tariff starts to get absorbed by the end customer itself. So the last couple of quarters, we have seen the exporter, that is SRF or UPL, then the importer, which is a distributor in US, he has been absorbing some amount of the tariffs, and only 30 to 40% of the actual tariff amount has been passed on to the customer till now. We believe in the next 2 quarters, this 30 to 40% will become 100%. And like I mentioned, there's already, I mean, with the trade deal, there's already a reduction in the punitive tariffs. So those things will come down. And because of it, overall, we see there will be an improvement in the volume, there will be an improvement in the margins, and hence these companies can start doing well. Now, some of you may have looked at SRF as a technical idea as well. Now, please beware that stocks that are recommended to you based on technicals will have a different investing mindset versus stocks that have been recommended to you based on fundamental research. Right. So, the stocks that have been recommended to you based on technicals, you are required to follow a proper stop loss to that and a target to that. So, that what the team does is, as soon as the stop loss or the target is hit, it will give you an update for the technical call. But for a fundamental call, it will be driven by what we do in the backend as research, wherein we keep evaluating the stock performance in the future from here on, and we keep looking at what the valuation that the company can get. For example, a company like an SRF, we believe today they could do an earnings per share of almost 100 and 120 rupees, and the valuation multiple for it should be around 25 to 30x. Now that works out somewhere around 3,000 rupees, which is what the stock is currently trading at. So if we feel that this 100 to 120 earnings that we are thinking about can improve materially, say, something like 150 rupees, then we will give you an update on that, guys, it's a time to add that to your portfolio. Right. So this kind of thing will happen. This will happen from a fundamental perspective, which we call as the stylus tactical bets. In the stylus technical bets, you were given a call primarily based on the price volume action in that particular stock. And if the price volume action has changed, wherein the momentum is lost, then it is better to exit the stock even if you're at a small loss. Right. If you have any query, when a recommendation is being given to you and you feel that you want to take some other action, the relationship managers have been tagged with you. Please reach out to them over call. You can discuss with them what you think can happen and what should you do, and they will be happy to help you out in that. Same applies for UPL as well. I don't think there's anything specific to add to that. UPL, we also had this partly paid shares. If some of you are holding that, keep holding. Like I said, those are specific stock related questions, and I think the relationship managers are the best just for to help you out on that. Okay, this is an interesting question. So, why I think deal has not happened? So, please, I am not saying that trade deal has not happened with between India and US. There is a trade deal, but that is a temporary deal. It's called an interim trade deal. Okay. Earlier, that is on Thursday night, as well as on Monday night, it was only announced that it was announced by the US President Donald Trump that they have done something and 50% will come down to 18%. but there was no clarity on how it will happen or when it will happen. This will, like I said, be dependent completely on what the real metrics are, right? So I don't see any other way to it. Let the actual deal happen, then we will know what's really available for investors as well as consumers. Buyback. So it would be slightly confusing to what we showed, but like I said, what's happening with buybacks is that your say last year we had this Infosys buyback, right, 3 months ago. So in that buyback, if you had bought, we had recommended also, like there's a 10 to 12% trade if your tax bracket is 10% or lower. Okay, so now what happens is if you actually bought the shares, but this is financial year, right? Okay, this whatever that's happened in the budget is not applicable to this Infosys buyback. But what can happen after 1st April if any buyback is implemented? In that case, what we are going to see is that say you bought the same Infosys shares at 1500 rupees, and versus this 1500 rupees, the buyback price is 1800 rupees, right? So your cost is 1500. In the buyback, you are giving it for 1800 rupees. So 300 rupees is the capital gains. On that, if it is a short-term capital gains, you'll pay 20% tax to it. Now, what if it is like your holding is much higher? So if your holding is more than 2 lakh rupees, what, for example, if you are holding 20 shares of Infosys, that's worth 3 lakh rupees, right? 30,000, 200 shares of Infosys, it's worth 3 lakh rupees. Now, if you're holding 200 shares of Infosys, then your buyback transaction will not come inside the capital gains quota. It will be taxed, like I mentioned, at a full slab income. And the cost that you had, you can take that as a capital loss and adjust. So that is the old method. So if your holding is less than 2 lakh rupees in that particular stock and you apply for the buyback, the transaction is eligible for buyback as a retail investor, and hence you can get the benefit of booking that capital gains and getting the beneficial rate of 12.5 or 20%. I hope it is clear now. So we have the last question. This is on the market specifically. The returns have not been generated by the stock ideas. So all I can mention to you right now is that this 8 to 10% profit making that we talk about, right? Now this is a very subjective thing. Like I said, we are looking at technical ideas to make that 8 to 10% profits and give you exits accordingly. But as a philosophy, as an equity investor, we do not believe in these kind of short-term ideas. We would rather want to position the portfolio that over a 3 to 5 year horizon, you are able to generate 15-18% or higher returns on your portfolio. Does that mean that 1.5 years, next 1.5 years also will be making losses? The answer is not really. Like I said, it is again dependent on how the markets are performing. But on an average, over a 3 to 5 year horizon, you need to have a slightly longer term horizon. If you're just thinking last 1 year what happened and next 1 year what happened, you will get disappointed by the market, because that is how markets work. In market cycles, many investors that have got in the last 1.5 years will, the market many times makes them cry and even pushes them, throws them out of the market. So you will have to play the long game of being invested for a longer horizon to actually start seeing that kind of performance for your individual portfolio as well. Okay, with that, it's already 12 and we'll try to wrap up for the day. Thank you so much, everybody, for joining in. Next month, we will do another call wherein we will discuss specific stocks as well as give, we'll be open to discussing specific stock ideas as well. Thank you so much. Bye.